There's an investment with a guaranteed, risk-free 21.47% return that Wall Street doesn't want you to know about. That number comes directly from the Federal Reserve. It's the first of 5 boring secrets smart investors use to build wealth with certainty. Here's what they are, with the real numbers. Let's start with the first and most powerful, boring move to build wealth with absolute certainty. This is the guaranteed 21.47% investment. Now, you're probably thinking, a guaranteed return that high sounds impossible. And in the stock market, it is. But this investment isn't in the stock market. It's in your wallet. The secret is to reframe how you think about paying off high-interest debt. It's not an expense. It's the single best risk-free investment return available to most people. Here's why. According to the latest G19 report from the Federal Reserve, the average interest rate on credit card accounts that are assessed interest is 21.47%. This isn't a hypothetical number. It's the national average as of the fourth quarter of 2024. When you carry a balance on a credit card with that interest rate, you are paying the bank 21.47% for the privilege of borrowing their money. But if you have cash on hand and choose to pay off that debt, you are effectively saving yourself that 21.47% in interest payments. Mathematically, this is identical to earning a 21.47% tax-free, risk-free return on your money. No stock, no bond, no piece of real estate can guarantee you that kind of return with zero risk. Think about the contrast. People pour money into highly speculative assets like cryptocurrencies or the latest meme stock, hoping for a big win, but those assets come with zero guarantees. They could go up 100% or they could go to zero tomorrow. There is no certainty. Meanwhile, paying off your credit card debt offers an ironclad, legally binding guarantee. The moment you pay off that balance, you have locked in a return equal to the interest rate you were paying. It's not exciting. It doesn't make for a great story at a party, but it is the most mathematically sound and certain way to improve your financial position instantly. Stop thinking of it as debt. Start thinking of it as your single best investment. Let's do the math for our example character, Alex, to make this real. Meet Alex. Alex is 28, works as a graphic designer in Austin, Texas, and earns a solid salary of $75,000 a year. Recently, Alex moved into a new apartment and used a credit card to cover about $5,000 in setup costs. The sofa, the desk, the kitchen supplies. Now that $5,000 balance is sitting on a credit card with a 21.47% interest rate, and the minimum monthly payments feel like a constant drain on their budget. Just this week, Alex received a fantastic surprise, a $5,000 work bonus. The temptation is immediate. Friends are buzzing about a hot new tech stock, and Alex thinks, maybe I can invest this bonus, double it quickly, and then pay off the credit card and have money left over. This is a classic financial crossroads. Let's analyze the two paths. Path A is investing in the speculative tech stock. The potential return is unknown. It could be 50% or it could be negative 50%. The risk is extremely high. Path B is the boring move, paying off the credit card. Let's calculate the guaranteed return. The annual interest Alex is paying on the debt is $5,000 multiplied by 21.47%, which equals $1,073 per year. That's over $1,000 a year just vanishing into interest payments. By using the $5,000 bonus to wipe out the debt, Alex isn't just eliminating a cost. Alex is effectively earning a guaranteed tax-free return of $1,073.50 for the year. That's a 21.47% return locked in with zero risk. When you compare a guaranteed $1,073.50 gain with the complete uncertainty of the tech stock, the choice becomes clear for anyone focused on building real, sustainable wealth. Alex pays off the credit card balance. The immediate result isn't just a stronger financial statement. It's the lifting of a huge mental weight. The cash flow that was going to minimum payments is now freed up, and Alex has a sense of financial peace of mind that a risky stock with its constant ups and downs could never offer. This is the foundation of building wealth with certainty. Comment below what your highest credit card interest rate is. You don't have to share balances, just the rate. You'll be shocked how common 20% or more is. All right, that was boring move number 1. Now for boring move number 2, where we find the closest thing to free money that exists. This move is all about claiming a part of your salary that your employer has set aside for you, but only gives you if you take one simple step. I'm talking about your employer's 401k match. So many people see this as a benefit or a perk. This is the wrong way to think about it. An employer match is not a benefit. It is part of your total compensation package that you must actively claim. If you don't, you are literally refusing a guaranteed raise. There is no other investment in the world that offers a 50% or even 100% instantaneous, risk-free return on your money. The moment you contribute, your employer's matching funds are deposited into your account. It's an immediate, guaranteed profit before your money has even been invested for a single day. Let's break down the mechanics. A very common structure cited in reports from financial giants like Fidelity and Vanguard is a 50% match on the first 6% of your salary that you contribute to your 401k. This means for every dollar you put in, up to that 6% limit, your employer puts in 50 cents. If you invest $1 and it instantly becomes $1.50, you have made a 50% return. Period. There is no risk involved in that initial transaction. Failing to take advantage of this is like walking past a briefcase with your name on it, full of money, and just leaving it on the table. It is the single most important step you can take in your early to mid-career to supercharge your retirement savings. Let's go back to Alex. Alex's employer in Austin offers this exact plan: a 50% match on the first 6% of their salary contributed to a 401k. Alex, who is now debt-free thanks to our first boring move, is trying to be responsible and is contributing to their retirement. However, they only contribute 3% of their salary. Why? Because they feel like they can't afford to put more away. They believe that extra 3% is better used for daily expenses and lifestyle. Let's run the numbers and see the true cost of this decision. Alex's salary is $75,000. By contributing 3%, Alex is putting away $2,250 per year. Their employer matches 50% of that, adding another $1,125. So, Alex's total contribution for the year is $3,375. That's not bad, but they are leaving a significant amount of free money on the table. The full match is available on the first 6% of their salary. To get the full match, Alex needs to contribute 6% of $75,000. Which is $4,500 per year. If Alex does that, their employer will contribute 50% of that amount, which is $2,250. That's an additional $1,125 of free money from their employer just for increasing their own contribution. Think about that specific increase. To get that extra $1,125, Alex needs to increase their own contribution by $2,250, from $2,250 to $4,500. An extra $1,125 return on an extra $2,250 investment is an instant, guaranteed 50% return. That's an instant 50% return. But once that money is invested, how do you ensure it beats the so-called experts? The answer to that is in move number 3, and it involves a number that proves 90% of Wall Street pros are failing. So Alex looks at their budget. They realize that by making a few small tweaks, they can find the extra $187.50 per month, $2,250 per year needed to max out the match. They make the change in their company's HR portal. Instantly, their annual retirement savings jumps from $3,375 to $6,750, $4,500 from Alex, plus $2,250 from their employer. They have nearly doubled their savings rate, massively accelerating their path to retirement with zero additional investment risk on those matched funds. You've paid off debt and gotten your free money. Now for boring move number 3. The simple strategy that beats 9 out of 10 Wall Street experts. The common perception of investing, fueled by movies and TV, is that the goal is to be a brilliant stock picker, to find the next Apple or Amazon and beat the market. But this is a dangerous misconception. For the vast majority of people, the primary goal of investing is not to beat the market. It's to meet your own financial goals. And ironically, the very act of trying to beat the market often leads to underperformance. The evidence for this is overwhelming. Let's look at the data. S&P Dow Jones Indices publishes a regular report called the SPIVA report, which stands for S&P Indices versus Active. It's the definitive scorecard for the performance of professional active fund managers against their benchmarks. According to S&P's definitive SPIVA report, which tracks this very thing, nearly 90% of large-cap fund managers in the U.S. failed to beat their own benchmark, the S&P 500, over the last 15 years. Let that sink in. These are highly paid professionals with teams of analysts and sophisticated tools, and 9 out of 10 of them failed to do better than a simple, unmanaged index of the 500 largest U.S. companies. Why does this happen? 2 main reasons: fees and behavior. Active funds charge much higher fees than simple index funds, creating a performance hurdle they must overcome just to break even with the market. Second, even professionals are prone to behavioral biases, chasing hot trends or panic selling during downturns. Therefore, the most logical and powerful move is to simply accept the market's average return. The boring move of buying a low-cost S&P 500 index fund, like VOO from Vanguard or FXAIX from Fidelity, and just holding it, makes you a top decile performer by default. You are mathematically guaranteeing that you will outperform the vast majority of the pros over the long run, simply by choosing not to play their game. Let's check back in with Alex. Having secured the full 401k match, Alex now wants to invest more in a separate brokerage account. Some friends are buzzing about a star fund manager who had an incredible return last year, something like 40%. Alex is tempted, thinking, this person must be one of the brilliant 10% who can consistently beat the market average. It's easy to be seduced by short-term performance. But Alex remembers the SPI VA data. Even if this manager was brilliant last year, the data shows there's a 90% chance they will underperform a simple index fund over the next 15 years. Past performance is not an indicator of future results. Alex digs a little deeper and discovers the Star Manager's fund charges a 1.5% annual expense ratio, while an S&P 500 index fund charges something like 0.03%. That high fee acts as a constant headwind, making it even harder for the manager to win. So Alex makes the boring but incredibly smart choice. They open a brokerage account and set up automatic investments into a low-cost S&P 500 index fund. They're not trying to be a hero. They're simply capturing the market's return, which historically has averaged around 10% annually. It's important to stress this is a historical average and is not guaranteed like the debt payoff or the 401k match. But by choosing this path, Alex ensures they will capture that return and mathematically outperform almost all the professionals trying to be clever. Okay, we've covered massive growth and beating the pros. But wealth isn't just about growth, it's about stability. Let's shift gears from offense to defense with boring move number 4. Building a financial fortress for your cash. We're on to boring move number 4. This one isn't about getting rich. It's about making sure you never become poor. Any investment plan, no matter how brilliant, is fragile and destined to fail without a solid cash buffer for emergencies. Life happens. The car breaks down. You have an unexpected medical bill, or you lose your job. Without a dedicated emergency fund, you'll be forced to sell your investments at the worst possible time or go into high-interest debt, destroying all your progress. This cash buffer is the foundation of certainty upon which your entire financial life is built. The mistake most people make is where they keep this cash. For decades, the standard advice was to just put it in a savings account at your local bank. But in today's environment, that's a recipe for losing money. Leaving your emergency cash in a traditional checking or savings account, which often pays 0.01% interest, means you are losing purchasing power every single day due to inflation. According to the latest data from the Bureau of Labor Statistics, the Consumer Price Index, or inflation, is running at 3.1%. Any cash not earning at least that much is actively losing value. Your safety net is leaking. The boring but optimal solution is the High Yield Savings Account, or HYSA. These are still FDIC insured, perfectly safe bank accounts, but because they are often run by online banks with lower overhead, they can offer dramatically higher interest rates. As tracked by sites like Bankrate and NerdWallet, accounts from banks like Ally or Marcus are offering rates around 4.8% APY right now. This simple move from a traditional savings account to a high-yield one turns a losing position into a winning one. Let's see how this works for Alex. Alex has been successful with our first 3 moves. They've paid off their credit card debt, are getting their full 401k match, and are investing in an S&P 500 index fund. Now it's time to build that emergency fund. Alex's monthly expenses are about $3,800, so they aim for a 3-month emergency fund, which comes to $11,400. They diligently save up this amount, but it's currently sitting in their primary checking account, earning next to nothing. Let's say 0.01%. Let's calculate the real cost of this. First, the loss to inflation. With inflation at 3.1%, Alex's $11,400 is losing $353 in purchasing power over the course of a year. Their safety net is shrinking. Now, let's see what happens when they make the boring switch to a HYSA, paying a competitive 4.8% APY. The earnings on that same $11,400 would be $547 per year. By moving the money from one safe, boring account to a slightly better, boring account, Alex has created a net swing of nearly $900 per year, from losing $353 to gaining $547. It took 5 minutes to open the new account online and transfer the money. The funds are still safe, still accessible, but now they are actively working to protect their own value from inflation, so your emergency cash is safe. But what about savings you want to protect from inflation with the full backing of the U.S. government? That brings us to our final boring secret, the I bond. And finally, boring move number 5. This is for the money you absolutely cannot afford to lose to inflation. You have your emergency fund in a HYSA, which is great for liquidity. You have your long-term investments in the stock market. But what about money for a medium-term goal? Perhaps a down payment on a house in 3 to 5 years, or a wedding fund. This is money you can't expose to stock market risk because the timeline is too short. But you also don't want it to get eaten away by inflation sitting in a savings account. For this specific need, the U.S. Treasury offers a unique and powerful tool, the Series I Savings Bond, or I Bond. These are not exciting. You can't trade them daily, but they are designed with one specific purpose: to protect your money's purchasing power from inflation. The interest rate on an I bond is a composite rate made up of 2 parts: a fixed rate that stays the same for the life of the bond, and a variable rate that is tied directly to inflation. This means that by its very design, it helps your money keep pace with and often beat inflation. According to the U.S. Department of the Treasury, the current composite rate for I bonds is 5.27%. This is a return that beats both the current rate of inflation, 3.1%, and the rates on even the best high-yield savings accounts, around 4.8%. And crucially, these bonds are backed by the full faith and credit of the U.S. government, making them one of the safest investments on the planet. There are a few key rules to know. You have to buy them directly from the government's Treasury Direct website. You can't touch the money for the first year. And if you cash them out before 5 years, you forfeit the last 3 months of interest. This makes them unsuitable for your emergency fund, but perfect for that medium-term savings goal. Let's return to Alex one last time. Alex's financial foundation is now incredibly solid. They have an $11,400 emergency fund in a HYSA. Now they're starting to think about a goal that's a few years away. Maybe a down payment for a condo. They've saved an additional $2,000 for this goal. They know they don't want to put this money in the stock market because they might need it in just a couple of years. A HYSA is a good option, but they wonder if there's an even better, safer choice that guarantees a real inflation-adjusted return. This is where the I bond is the perfect tool for the job. Alex learns about the 5.27% composite rate, which is higher than both their HYSA and the current inflation rate. They understand the rules. The 1-year lockup is fine, as their goal is at least 2 years away. So, Alex goes to Treasury Direct and puts the $2,000 into an I bond. They have now locked in a rate that is guaranteed to beat inflation, diversifying their savings and using precisely the right tool for the right job. Alex has completed their foundation of certain financial moves, creating a stable base from which to build lasting wealth. So let's recap the 5 boring but incredibly powerful secrets to building wealth with certainty. 1. Pay off high-interest debt. Your credit card's 21% plus interest rate is a guaranteed risk-free return when you eliminate it. 2. Maximize your 401k match. It's not a perk. It's part of your salary, and it's the only 50 to 100% instant return you'll ever find. 3. Use S&P 500 index funds. By accepting the market average, you are statistically guaranteed to outperform 90% of the professionals who are trying to be clever. 4. Put your emergency fund in a high-yield savings account. Don't let your safety net lose value to inflation. A HYSA paying 4.8% or more turns a losing position into a winning one. And 5. Use I bonds for medium-term savings. With a government-guaranteed, inflation-protected rate of 5.27%, it's the perfect tool for goals 1 to 5 years away. Here are your action steps to make this real. Immediate. Do this today. Log into your credit card account, find your interest rate, and calculate your guaranteed return on paying it off. Seeing that number will change your perspective. Short term. Do this week. Log into your 401k provider's website and increase your contribution percentage to get the full employer match. It takes 5 minutes and could be worth thousands of dollars a year. Long term. Set this up this month. Open a high-yield savings account for your emergency fund and a brokerage account for your investments. Set up automatic transfers to both so these boring, powerful moves happen effortlessly in the background. If this data-driven approach helped clear up your financial confusion, hit the like button so more people can find it. And be sure to subscribe and turn on notifications, because our next video breaks down the 3 most common fees that are silently destroying your investment returns. This video is for educational purposes only and is not financial advice. All numbers are based on data available in late 2024 from sources including the Federal Reserve, the Bureau of Labor Statistics, and S&P Dow Jones indices, and are subject to change. Consult with a qualified professional before making any financial decisions.